Good morning. Welcome to Stock Market Today. It's Wednesday, December 12th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Over on StockTwits under the same handle. Stock Market Today brought to you today and every day by Chaikin Analytics, and you can head over there to sign up for a free email to follow along with this show, as well as receive free stock ideas every day. Head over to chaikinanalytics.com/today. Diving right in, U.S. equities are narrowly mixed yesterday, but that doesn't really tell the whole picture because it was a choppy day. Stocks tried to rally in the morning and then gave up those gains to close lower. Defensives and healthcare led, while financials and industrials were the worst performers. Treasuries were weaker, with the curve flattening a little bit. The dollar was stronger against the euro and sterling, but little changed against the yen. Gold finished down 20 basis points. WTI crude rallied by 1.3%. Breadth on the New York Stock Exchange, negative 1.2 to 1. Breadth on the NASDAQ, negative 1.3 to 1. So your outperformers, staples, healthcare, utilities, and comm services. That's definitely a defensive bent. Your underperformers, as we said, fins, industrials, and add materials to that mix. And as we arrive at the desk this morning, S&P 500 futures are up 70 basis points. Asia was mostly higher overnight, led by Japan, which was up over 2%. European markets are seeing some good gains as well. Treasuries are unchanged to a bit weaker at the back end of the curve. Dollar lagging, sterling and euro flat against the yen. Gold up 20 bips. WTI crude also up to the tune of about 2%. Had a big stockpile draw in the API data that came out after the close yesterday. So when we roll all that up and we dive in, yesterday was really the opposite of Monday. Monday we had open, trade lower, rally back to close up on the day and hold support. Yesterday we had the opposite approach. Yesterday we opened and rallied, tried to push through 2675, couldn't get there. Market started to fade, a lot of back and forth. President Trump tweeting about some progress on trade sends the market higher. President Trump, during a press conference, says he is threatened to shut down the government if he didn't get funding to build a wall, sent the market lower. This, again, why we advocate having a process and not trading off of the latest headlines and tweets. That's not a process. That's going to get you chopped up. We have a process. We run through it every day in our notes, Chaikin Analytics members. Support remains in the 2630 area, then below that 2570 to 2600. The interim highs near 2815 are still the key level for the bulls. So now, despite those positive divergences in RSI, the indicator does remain in bearish ranges, confirming the weakness that we've seen in price. Chaikin money flow remains bullish, but it is beginning to back off. So that's something we want to keep an eye on. So still a lot of mixed signals here. Support holding at 2630. But the key level for the bulls, if the bulls want to take control, they have to take the market above 2815. Has not happened yet. Your market in a minute. What I'm talking about in my notes, Chaikin Analytics members today. Stocks finish lower after a strong start. Defensive sectors outperform. We'll take a look at staples here. Financials remain under pressure. They were the biggest underperformer yesterday. We'll take a look at that group. Sentiment remains fearful. And what I'm starting to wonder is, as the market holds support at 2630, can this bearish sentiment provide a contrarian rally? History would say yes, but we haven't gotten there yet. Futures do point to a higher open today, so maybe that's the start. Looking at the power bars for the major indices, Dow, 2 bulls to 5 bears. S&P 500, 46 bullish or very bullish stocks, 110 bearish or very bearish stocks. NASDAQ outperformed on the day, 9 bulls, 21 bears. Small caps underperformed again, 149 bulls, 481 bears. For those of you who receive my bearish insights note on Wednesdays, comes out every Wednesday. That's a weekly note. We're talking about the small caps and the mid caps and how there are opportunities on the bearish side in those two groups because of the relative underperformance. Bonds down tick slightly. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain bearish. Major indexes are all bearish. And when the indexes are bearish and defensives are outperforming, it makes sense to pay attention to drug stocks. And our stock of the day today, auto-generated, by the way. I do not pick this stock. It's auto-generated by our algorithm based on the Chaikin Power Gauge rating. Our stock is Pfizer, closed 44.01 yesterday, underperformed down 88 basis points. Power Gauge rating for Pfizer is very bullish due to very strong earnings performance and very strong price volume activity. When we roll up the 20 factors that fall into these four groups, we come out with that very bullish rating. Very bullish stock, strong trend, weak industry. Remember, we've talked about the drugs. A lot of smaller names in there with bearish ratings. But let's run through the analysis, and I'm going to caveat, or not caveat, but just in full disclosure, say I own Pfizer in my personal account. It is a 401k. It's not traded actively. I like the stock. I like the company. I own it, but I wanted to put that out there. We've been on this bullish rating since July. Stock's been outperforming since late July, and the intensity of the outperformance is increasing. Money flow, look at the mounds of green on the money flow as the stock trends higher. We've pulled back to test support here in the $43 area, rising long-term trend line. But for me, from a tactical standpoint, I think you want to wait until this stock becomes oversold. If you're a little bit more conservative. If you're on the aggressive side, you can use this test of support to add to positions. But I think a higher probability trade, as always, is to wait until we become oversold, especially in light of the fact that we do have a negative divergence here. This high above $46 was met with a lower high in our overbought, oversold indicator. That's a negative divergence. It's a warning sign. At the very least, it says you don't want to chase these highs, and maybe you want to be a little bit more conservative. I always like to wait for an oversold condition, but the weight of the evidence does support being long Pfizer. PFE is our stock of the day. Sector tracker, looking at the movement of the major sectors over the last 5 days. And what we can see is not a lot has changed. We can see here that it's defensive in nature, right? Utilities, real estate, and communication. Remember, communication had a change, right? Names like Google and Facebook are in there now, but it still maintains a lot of those defensive traditional communication stocks, stocks like Verizon that are seen as defensive, and obviously the staples are defensive. So your top four groups over the past 5 days are all defensive in nature. Financials just continue to be under pressure. Energy really can't get much going, even as oil tries to stabilize. Materials and industrials are under pressure. That's a function of trade concerns. Middle of the road, tech, healthcare, discretionary, which is interesting because those are your beta groups. Those are the groups that you want to see outperforming. Our industry in focus today is one that we watch every day, haven't really commented on all that much. We've been bearish on semiconductors. That's been the right call because over the last 6 months, semiconductors have underperformed the S&P 500 by about 8.5%. And a power bar ratio, which measures future potential, is very weak with more bearish than bullish stocks. It's currently ranked number 17 of 21 subsectors. And some of the indicative names there, Qualcomm, very bearish rating, Semtech, very bearish rating, as well as AMD with a very bearish Chaikin Power Gauge rating. 17 very bearish or bearish stocks, only one bullish or very bullish stock for the group. So we know that that's one we want to avoid. And in particular, we watch how semiconductors are performing on a relative basis to give us a read on the market. Now, one of the names here that I think sets up as a potential bearish idea is Qualcomm. Qualcomm's a very bearish stock with a weak trend and a weak industry group. Ribbon at the bottom of the screen tells us where the power gauge rating is and has been. You can see we're on that very bearish rating. And in early November, the market and model got into agreement. Dynamic duo in gear here. That's what we're looking for. Stock currently closer to rounding out of overbought. So call it overbought with bearish money flow. Ticking here into the 21-day moving average below the falling long-term trend line. I think Qualcomm sets up as a bearish idea. Whether you short the stock outright, whether you look at put options, whether you look at vertical put spreads, however you want to play it, I think you can set up a bearish position in Qualcomm. And at the very least, I think if you own Qualcomm, you need to get it out of your portfolio. This is really setting up to turn into what we like to call a Chaikin Classic bear. I think it could be a portfolio killer going forward. you want to get that name out of there. Qualcomm, bearish. Yesterday's S&P 500 movers and shakers, gainers and losers. Avago up over 3%, been a volatile name since earnings, but possibly positive benefits if the trade war is in fact being ironed out. Positive trade talks there helping Avago. Didn't see any real news to send Twitter up 3%. Campbell Soup, CPB. This is a special situation with activists involved, but what in the dearth of news on the activist front, it's going to be treated as a consumer staple, and it's going to outperform in a defensive environment. Same with Church & Dwight, CHD, up 2.73%. PerkinElmer, PKI, is a bearish stock. I didn't see any real news to send that stock higher by 2.87% yesterday. On the loser side of the board, FLR. They hosted an analyst meeting or a sell-side meeting yesterday where the analysts came away feeling like numbers were too high, both on revenue and on margins. Commentary there took that stock lower by 5.3%. National Oil Well Varco, NOV, caught a downgrade from a really good research shop. That stock has a very bearish Chaikin Power Gauge rating, part of the energy complex that we've been wanting to avoid. Darden, DRI, restaurant name again. For those of you who are subscribers to my bearish insights note on Wednesdays, you've heard me talk about the restaurants and how ugly they are. Darden down 3.43%. Consumer discretionary, certainly not defensive. RE down 3.24%. Didn't see any real news there. And CBS, bearish stock down over 3%. Again, consumer discretionary, not considered defensive. What is considered defensive, though, is consumer staples. Here's XLP relative to SPY. So consumer staples relative to the S&P 500. Nice breakout, consolidation, and now we're starting to move higher once again. This is the ratio. It's above the 200-day moving average. 200-day moving average has gone from declining to flat to now ever so slightly starting to move higher. The RSI of the ratio has shifted into bullish ranges, confirming the strength of the outperformance. And the last piece of the puzzle that hasn't quite fallen into place yet is an absolute breakout. I wouldn't be surprised to see an absolute breakout follow a relative breakout. Regardless, consumer staples are a defensive group. Defensive stocks are outperforming. Look at the utilities. Look at the REITs. Look at the defensive parts of healthcare. Drop consumer staples into that bucket. Name you want to think about is Revlon, ticker symbol REV, bullish rating, strong trend, outperforming the market, oversold with bullish money flow after testing the rising long-term trend line. I think Revlon is a name that you want to consider as a long idea. I have it as my long idea for Chaikin Analytics clients in my notes today. So as I said, financials continue to come under pressure. Here's that same chart as staples, except for financials now. Looking at the XLF relative to the SPY, so financials relative to the broader market, and you can see the breakdown. And the intensity of underperformance is picking up. We are below the 200-day moving average. Now, the RSI is entering oversold. This is the RSI of the ratio, is entering oversold ranges, but notice it hasn't registered an overbought reading since July 2017, so in over a year. So momentum really kind of confirming the weakness on a relative basis, and now we're starting to test support on an absolute basis as well. Bottom of the screen here is the XLF, and if this support level gives way, that could spell trouble for anybody who's bullish on financials. I think the relative breakdown increases the odds that we are going to get an absolute breakdown as well. And sentiment is still more fearful than greedy. Here's that 13-period moving average of the CBOE put-call ratio. Uptick this week to 0.97. So under 1, but still elevated. That could, right? Bearish sentiment could provide contrarian firepower to a rally in the last couple weeks of the year, especially as the market holds support near 2630. So that's what we have for today. Sign up for the email. Head over to chaikinanalytics.com/today. Get daily stock ideas for free. You'll also be able to follow along with this show because a lot of content comes out of that email. And if you like what you're hearing, help us spread the word. Share our link on social media. I'll see you here tomorrow.